Hello, this week we'll be covering Chapter 2, Introduction to Financial Statements. In this outline, we're going to look at all the financial statements, which includes the income statement, statement of owner's equity, the balance sheet, and the statement of cash flows, and how they're interrelated. We're going to explain current versus non-current assets, current and non-current liabilities, equity, revenues, and expenses. We're also going to prepare an income statement, a statement of owner's equity, and a balance sheet. So the first thing we need to discuss is the types of business structures there are. There's a sole proprietorship, a partnership, and a corporation. A sole proprietorship is a single individual. It's easy to form. It's difficult to raise capital because of the amount of risk associated with it. It has unlimited liability, which means if someone sues you, they can sue you personally for anything and everything. And there's a single taxation. With a partnership, it is basically a sole proprietorship with multiple people in it. So you have two or more individuals. It's a little bit harder to form. It's harder to raise capital. And again, it's unlimited liability. What does this mean? Well, for example, if you are supporting the business and you have a lot of capital and you have a home and your partner does not, and maybe they rent, they can go after each of you for the same amount, or they could go just after one of the partners who has the most money. And again, they're single taxation. Now we have corporations, which are usually more than one owner, as well as it's very difficult to form. It's easier to raise capital because there's less risk associated with it, and it has limited liability. What does that mean? Well, the owners are semi-protected from legal lawsuits, and the only way the owners can be sued is if they blur the veil between the corporate entity and themselves. In other words, if you can't tell the difference between the owners and the corporation, and they're not, and the corporation isn't acting in its own best interest, that's the only way you can breach that limited liability. And then there's double taxation. Double taxation means not only is a corporation taxed, but the owners are taxed when they receive money as well. So every business, regardless of structure, needs to generate financial statements. And as we covered briefly, there's the income statement, the statement of owner's equity, the balance sheet, statement of cash flows. The purpose of financial statements are for the various stakeholders to be able to make business decisions. So briefly, this highlights that there's many segments to bringing these financial statements together. And ideally, once you bring everything together, as this analogy states, you have a final product that's beautiful and tastes good. In this case, it gives useful information to the stakeholders. Okay, let's talk about the income statement. You basically have three sections. You have the revenue, that's what your business is in business to do. That's what your primary revenue generation is from. That's primary services you provide or goods you sell. And then you have expenses. And these are expenses are associated with generating that revenue. So for example, in this case, if you have a landscaping business, then maybe you have tractor brake repairs, tractor fuel, business insurance, maybe rent insurance, maybe rental costs. So various different expenses can go into this. And then you have your net income. And this is basically the difference between your revenue and your expenses. If your revenue is greater than your expenses, then you're profitable. If your revenue is less than your expenses, then you are not profitable or you're making a loss. So an example, EA9, prepare an income statement using the following information. You have sales revenue of $62,500. You have rental revenue of $15,300. You have product expenses of $52,200. Wages expense of $18,900. Owner's investment of $12,000. And owner's investment is what the owners have put into the business. You have equipment purchases of $56,000, utilities expense of $1,800, and taxes of $400. So I've broken this up into three parts. The first thing you're going to do is generate what your revenue is. And in this case, it's your sales revenue and rental revenue. And the total revenue in this case is $77,800. Then the second phase is you're going to generate how much expenses do you have. In this case, you have $52,200 on product expense. You have $18,900 in wages expense, and you have $1,800 in utilities expense, and $400 in tax expense. So your total expenses are $73,300. And then the third thing to do is what is your net income or net loss? And basically, this is deducting your expenses from your revenue. You'll notice that the owner's investment, the equipment purchases, are not as part of the income statement. The income statement is in a period of time. And as we'll see later on, the owner's investment is a balance sheet item as well as equipment purchases. Okay, another problem, PA1. Basically, we want to look at the following information, where we have revenues for January of $22,500, gains in February of $1,200, losses in March of $3,700, expenses in February of $21,620, gains in January of 0, revenues in March of $42,800, losses in February for $1,600, expenses in March for $45,100, losses in January for $0, revenues in February for $37,550, expenses in January for $20,760, and gains in March for $5,600. Now what they want us to do is calculate the net loss or gain for each period, and then for each period make a comment on what's going on with the firm. So you notice I've highlighted in red. The key to this is getting the information sorted by month. So let's look at January. In January, we had total revenue expenses of $1,740, 0 gains or losses, which means a net income of $1,740. It says here as a comment, earnings from ongoing core portion of business. That means we're profitable for what we're in business to do. Then in February, we have revenues and expenses of $15,930, and then we have a $400 loss. Again, strong earnings from ongoing business, and then we have minor losses from one-off events. And then in March, we have a loss of $2,300 and a gain of $1,900. So we need to really look at what our core business is doing and how it's operating if we're making a loss on what we normally do. But we had a gain or loss of $1,900. So net overall loss of $400. We will discuss gains and losses in detail later, as well as revenues and expenses in greater detail later. So let's talk about this. Here we have a coffee shop. Let's talk about some items that we would classify as revenues. And for whatever reason, I think of Pete's Coffee or Starbucks. So what are they doing? What are they selling? Well, in most cases, coffee would be one of the first things that come to mind. But we can also think about the peripheral items like muffins and croissants and other items like that. Is there anything else you can think about that they sell? Now let's think about their expenses. What would some of their expenses be? Well, certainly materials, such as buying the coffee, sugar, milk, cream. Certainly their costs for buying the muffins and croissants, their salary costs, how much do they pay their employees, maybe delivery fees if they should happen to have delivery. What other costs can you think of? Okay, talking about gains and losses in greater detail. So if we think revenue and expenses are basically what the company is in business to do, gains and losses are one-off events or unusual events that the company is not in business to do. And here we talk about Chris's landscaping business. And a gain could be that he sells a business or a building or land and equipment. This isn't normally associated with what his business is designed to do. In that case, it's considered a gain. Losses could come from other things, like, uh, for example, he wrecks his tractor and he doesn't have insurance. This may not be considered part of his regular business. So, again, think of these as one off events that are not regularly part of their business. So, expanding on what we said with revenues and expenses, with adding gains and losses, revenues plus gains minus expenses minus losses equal net income if the revenue and gains are greater than the expenses and losses. And conversely, if the revenue and gains are less than expenses and losses, then that is a net loss. Okay, let's look at example EA1. For each independent situation, calculate the missing values. Again, this is basically formulaic. So here we're asked to figure out what's missing, and this is kind of a simple algebraic formula. I'll let you work through it on your homework, but you'll have the answers here. So for example, if we have revenues of $1,813 and expenses of $1,595 and gains of $181 and losses of $109, well, our net income is $290. And you'll see the formulas to the right. If you have expenses of $146,095, no gains, and losses of $2,248, and your net income is a loss of $703, then your revenues have to be $147,640. And basically, you can work through this problem. Okay, let's talk about the statement of owner's equity. Well, first we need to determine what is owner's equity. So, owner's equity is basically what value the owner or investor has in the business. This is a periodic report, which means it's a period of time, similar to the income statement. So here we start. This must be the first month that Chris's Landscaping is in business. And on August 1st, they have no equity. But in the first month, they've generated a net income of $250, which means at the end, their owner's equity as of August 31st is $250. Another term for owner's equity is net worth. As we'll learn later, it's basically assets minus liabilities. All right, so owner's equity. Basically, that's the investment by owners representing by exchange of cash or other assets, such as buildings or equipment, for which the investor is given ownership interest in the organization. So distribution to owners, periodic rewards issued to the owners in the form of cash or other assets. Distributions to owners represent some of the value equity of the organization. Put another way, This is normally how owners get paid for having a business. In a public corporation, it is called dividends when the distribution happens. In a private organization or a sole proprietorship or partnership, it is called a withdrawal. All right, so let's talk about the balance sheet. We talked about the income statement and statement of owner's equity being a period of time. So being for a month, a quarter, half a year, a year. Here with the balance sheet, we're looking at a specific date. So you'll see on the balance sheet, it'll say as of August 31st, 2020. So here we have the cash that the owner put in from the statement of owner's equity of $250,000. Now we have zero liabilities because, again, our business is just starting, and the owner's equity is $250,000. All right, now that we've talked about these three financial statements, how are they related? So we talked about the income statement and the net income being generated after the revenue and expenses of $250,000. This carries down to the statement of owner's equity, and this is added to the owner's equity, or if it's a loss, subtracted. Then we have the owner's equity of $250,000, and we have the cash generated of $250,000. Notice on the income statement, it's for month ended August 31st, 2020. And on the statement of owner's equity, it's for the month ended August 31st, 2020. And then on the balance sheet, it would be as of August 31st, 2020. In other words, as of that date or that day. All right, let's talk about the statement of cash flows. Again, this is over a period of time. And what we're looking at is cash inflows and outflows. So we have two types. There's a cash basis of accounting. Basically, we only record the transaction when cash is exchanged or paid. This type of accounting is permitted for not-profit entities and small businesses. However, in this course, the focus will be on accrual accounting. So what is the accrual basis of accounting? Transactions are recorded in the financial statement when the transactions occur, not when paid, not when cash is received, when it is incurred. In some situations, as it says, it can happen simultaneously or on the same day. So if a customer pays you in cash on the same day you perform service, then in that case, both events happen at the same time. So let's look at some examples of cash basis versus accrual basis. A $200 sale for cash, recorded in the financial statements at the time of sale in cash basis, as well as accrual basis. A $200 sale on account. In other words, they owe you the money, or it's an accounts receivable. On the cash basis, since cash is not exchanged, it is not recorded. However, it is recorded in the financial statements on the accrual basis. A $160 purchase for cash. That they're both recorded in the financial statements at the time of purchase. And $160 purchased on account. That means you owe the supplier or vendor. Again, not recorded on the cash basis form of accounting, but it is recorded in the accrual basis of accounting. All right, let's look at a simple cash flow. So Forest Company had the following transactions during the month of December. What is the December 31st cash balance? So we had cash sales of $3,250. We had payments for inventory of $1,760. We had investments by the owner of $3,000. We had supplies used of $175. We had cash withdrawals of $260. We had inventory received of $2,500. We had wages paid of $2,390. And our cash balance on December 1st, or the starting balance, is $4,250. So this is the format we take. So on December 31st, we have $4,250. We talk about our cash inflows, and that came from cash sales and investments by owner. And that totaled $6,250. And then we had our cash outflows. That was the payments for inventory, the cash withdrawals, and the wages paid of $4,410, which totals, when we add the inflows and less the outflows to the beginning balance, it totals $6,090. So there's also non-cash activity that they tried to trick us with. And we'll get into more detail in the future chapters on this. But supplies used is not a cash activity. Just because you use the supplies doesn't mean you have to pay cash for it. Inventory received is a non-cash activity. Why? Because it's not necessarily associated with cash. Either you paid cash when you received it or you put it on account, but when you received it doesn't really matter. All right, let's talk about current versus non-current. All right, a current asset is one that will be consumed in 1 year or less. And when we say 1 year, we really mean 12 months. That is a current asset. And then if it's greater than that, that means it's a non-current. And that's similar to a liability. It's expected to be settled in 1 year or less for a current liability. And if it's greater than that, it'll be a non-current liability. So let's think about what current versus non-current examples we have. So some current assets are cash, accounts receivable being the expectation we'll collect it in a year. Notes receivable, you'll see it's in both categories. And why is it in both categories? Because if a note receivable is greater than 2 years, for example, or greater than 1 year, then a portion of it will be a current asset and a portion of it will be a non-current asset. And then we have inventory. And inventory is expected to be converted into cash within 1 year. And then we have non-current assets. And those are buildings, land, and equipment, which are longer term assets. And we have patents, which can last up to 20 years. Then we have current liabilities, which are your accounts payable and your notes payable. Again, look at your notes payable. It can be both a current and a non-current liability, which means that if it's greater than a year to be repaid, then a portion of it would be in the current liabilities and a portion of it would be in the non-current liabilities. Okay, stakeholders use financial information to make decisions. Providing amounts of assets and liabilities answer the what question for stakeholders. But it does not answer when question for stakeholders. What does that mean? Here's an example. Knowing that your organization is worth $1 million of assets is valuable information. But knowing that 250,000 of those assets are current and will be used or consumed within 1 year is more valuable to stakeholders. It really gets around to liquidity. If you have a lot of long-term or non-current assets and short-term liabilities, you could have a liquidity issue, which means you might owe more money immediately and faster than you can generate it. So let's say we're $1 million worth of assets, but our company owes $750,000 worth of liabilities. And 125,000 of those liabilities need to be paid within a year. This would be very interesting. And the reason is, what you'll learn is it's possible to be a profitable business, but yet still be insolvent, which means going bankrupt in essence, because you don't have the assets to generate the current revenue and profit that you need now. Okay, borrowing. When money is borrowed by an individual or family from a bank or other lending institution, the loan is considered personal or consumer loan. Typically, payments are these types of loans begin shortly after funds are borrowed. But student loans are a special type of consumer borrowing that has a different structure for repayment of the debt. In brief, I broke out the difference between a student loan and a personal loan. So the purpose for a student loan is obviously to attend school, to get room and board and books, where a personal loan can be used for debt consolidation, home improvements, and various other things. The lender is usually the federal government or a private institution for a student loan, where a personal loan is bank, credit unions, online lenders, and other financial institutions. Interest rates on federal loans are normally much lower than a private loan. Private loans can have fixed or variable rates, often higher than federal loans and dependent on credit worthiness. Federal loans are normally deferred until graduation. But with private loans, in some cases, it can differ. Either it's deferred during school or after school or may require immediate repayment. Typical personal loans are repaid within 1 to 7 years and repayment starts immediately. Interest paid on student loans may be tax deductible, where interest on personal loans may not. And here's a critical piece. Student loans, both federal and private, normally cannot be discharged through bankruptcy. So even though you claim bankruptcy, you still owe the student loan, where that's not necessarily true for a personal loan. So put another way, um, you can repossess a car or a house, but not an education. All right, now, assuming a college student has two loans, one for a car and one for a student loan. Assume the person gets the flu, misses a week of work at his campus job, and does not get paid for the absence. Which loan would the person be concerned about paying and why? And as we discussed, probably be the personal loan. One, because the student loan is deferred until after their graduation, and a personal loan is immediate. And two, usually those loans are collateralized, as I talked about. So if you have one for a car and you miss it, they can repossess the car. Okay, let's look at equity and legal structures. So we talked about sole proprietorships, partnerships, corporations. For a sole proprietorship and partnership, terms of an owner's investment is capital, where for a corporation it is common stock. As we talked about, when an owner takes distribution from a sole proprietorship or partnership, it's called a withdrawal. From a corporation, it's a dividend. For the equity terminology, owner's capital is for a sole proprietorship, partner's capital is for a partnership, and we have retained earnings for a corporation. Okay, this is a critical principle. We need to understand this. We need to understand that assets equal liabilities plus owner's equity. This is called the fundamental accounting principle or accounting equation. This will be prevalent throughout the remainder of the course. So let's assume we purchased a home valued at $200,000 and made a payment of $25,000 by financing the remainder. So what would it be? Our asset, which is a home valued at $200,000, our liabilities would be the bank loan of $175,000. And then our owner's equity would be $25,000, which was the down payment that we made. All right. This is more of a thought exercise, so I'm not going to require 3 columns to create your own accounting, but it's definitely worth thinking about. And it might be beneficial for you to understand your net worth or your owner's equity. So it's asking us to basically put some examples in our personal lives of assets, liabilities, and owner's equity. So I put down some examples. This obviously is not true for everyone, but I think you get the gist. So let's talk about a car with a loan, similar to the house with the mortgage. We have a $10,000 value of a car. We owe $3,500 on it. That means our owner's equity is $6,500. Let's talk about a car without a loan. That would be a $10,000 asset and $10,000 owner's equity. Let's talk about our bank account, our bank balance. That could be a $1,000 asset and a $1,000 owner's equity. A credit card. Well, a credit card would be $500 liability and a loss or a negative $500 owner equity. Let's talk about home with a loan, $200,000 asset. We owe $150,000 in liabilities. The owner's equity is $50,000. House without a loan, $200,000 asset and a $200,000 owner's equity. So I totaled the balances on the assets, liabilities, and owner's equity. And for the assets, we have 421,000. For liabilities, we have 154,000. And for owner's equity, we have 267,000. So the asset is 421,000. And when you add up the liabilities and owner's equity, that is 421,000 as well. So our formula works. All right, let's consider something else. Is it possible to have negative equity? Absolutely. In this case, we're talking about personal student who has taken out loans. So what they're saying is you may not see any assets directly associated with that loan. But is that accurate? Is that negative equity really reflective of the student's circumstance? Well, it could be at that moment of time. But what we're talking about is there's a benefit to college. And so it's a matter of lifetime earnings versus with your degree versus without. And as we've shown, lifetime earnings, having a college degree is more often than not greater than the actual loan taken out. However, if we were recording this on a balance sheet, all we would see is that we have a loan. Is this true for businesses? Can they have negative equity? Absolutely. If the business is making losses year over year, it's possible to consume your equity and have negative equity. In other words, it would require additional capital or funding to run the business, which may mean owners, partners, investors need to put more money in the business for it to continue operating. Here's another way of looking at assets equal liabilities plus owner's equity. In this case, we're funneling in the income statement into the owner's equity. So what builds owner's equity and what takes away from owner's equity? So distribution to owners. Owners taking out money from the business decreases owner's equity. So does expenses, so does losses. And potentially so could a comprehensive income. I won't go into detail on comprehensive income. What adds to it? More investment by the owners, revenue, gains, and comprehensive income. Fundamentally, this is good to understand what increases assets what increases liabilities and what increases owner's equity, as well conversely, what decreases all three. Okay, now we get to learn an acronym so that you realize what decreases it and what increases it. So the acronym they chose to use for decreasing owner's equity is DEAL. Dividends, expenses, assets, losses. For increasing owner's equity, they came up with GIRLs. And that's gains, income, revenues, liabilities, and stockholders' equity. Okay, this is another way of looking at it. Transactions that affect equity, revenues increase, expenses decrease, gains increase, losses decrease, investments by owner increase, distributions or withdrawals decrease equity. Transactions that don't affect it. If it's completely balance sheet, in other words, you exchange an asset for another asset of like value, or you exchange a liability for another liability of like value, or you have an acquisition that incurs the same amount. In other words, you bought a $200,000 house, but you have a $200,000 mortgage, or settlements of liability by transferring assets. In other words, you don't have the money to pay your vendor, but they say, I'll take your cars instead for your business. If it's of like value, it doesn't impact your equity. Okay, let's talk about the various categories. So we have revenue, and revenue is the value of goods and services an organization sold or provided. Expenses are costs of providing those goods or services for which the organization earns revenue. Again, this is what the business is in business to do, is the revenue and expenses. Gains and losses. So gains are incidental or peripheral or one-time events that causes money to come in. We talked about selling a truck. And losses are incidental or peripheral activities that you're normally not in business to do. We talked about wrecking a truck without insurance. Assets, these are items that the organization has claim or controls. Liabilities are amount the organization owes to others or creditors. Equity is the net worth. Basically, we talked about assets minus liabilities. Investments by owners are cash or other assets put into the business by the owners to generate an ownership interest. And distribution to owners are either cash or also assets. And for sole proprietorships and partnerships, it's called a withdrawal. For a corporation, it's called a dividend. And then again, I won't go belabor comprehensive income, but it's related to foreign currency derivatives and investments and pensions. Things unrelated to what the business is in business to do. Okay, now we're going to talk about something called the trial balance. And the trial balance combines the balance sheet and the income statement. And it lists them in order. So revenues and expenses are first in the trial balance. And then you have your assets, liabilities, and owner's equity as the second part. And this is generated for each period. It's a period financial statement. So again, we have the month ended June 30th. So here we break out the income statement. And again, we have for this is Cheesy Chuck's Classic Corn. And they have revenues of $85,000. And they have expenses, various expenses, of $79,200. By the way, you will never see a miscellaneous expense in anyone's financial statement. Miscellaneous means we don't know what it is or we can't identify it. and then their net income is $5,800. Then we look at their statement of owner's equity. Their investment by the owner was, or their beginning capital is zero. Their investment by the owner was $12,500. Their net income was $5,800. So total increase of $18,300. The owner took out to pay themselves, I assume, $1,450, which means their total capital as of June 30th, 2018 is $16,850. And this should tie to the balance sheet. All right. Their cash is $6,200. Their equipment is $12,500. So their total assets are $18,700. Their accounts payable, what they owe to vendors and suppliers, is $650. Their wages payable, what they owe to their employees, is $1,200. Their total liabilities are $1,850. As we tied out, their owner's equity is $16,850 from the previous financial statements, which means their total liabilities and owner's equity are $18,700. And we see that total assets tied to total liabilities and owner's equity. Okay, so we'll briefly touch on liquidity ratios. Basically, what liquidity ratios are looking at is the time it takes to convert your assets and liabilities into cash. And working capital is your current assets minus your current liabilities. This is not a ratio. We're just looking for the one being greater than the other. Why is it important to have current assets minus current liabilities be a positive number? That means you can pay your current bills. And looking at the current ratio is current assets divided by current liabilities. Again, we want this to be greater than 1. Now, alone, these liquidity ratios don't mean much. What you need to do is compare yourself to other industries. And it may be different for different companies depending on where they are in their life cycle. For example, a startup may not have as much working capital as a company that has been in existence for 10 or 15 years. Okay, in summary, we talked about the financial statements and the importance the financial information has to the stakeholders. We talked about the 4 incomes or the 4 financial statements, which included the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. We talked about the income statement being a measure of financial performance over a period of time. The income statement lists revenues and expenses and gains and losses, which make up net income or net loss. The statement of owner's equity shows how the net worth of the organization changes. Net worth being assets minus liabilities over a period of time. It shows the investment spot and distribution to the owners. The balance sheet shows the organization's financial position as of a specific date. Balance sheet lists assets, liabilities, and owner's equity. The statement of cash flows shows the organization's cash inflows and outflows, as we saw in the example, over a period of time. The statement of cash flows is necessary because financial statements are usually prepared using accrual method accounting, which records transactions when they occur rather than until cash is exchanged. Again, it is possible to be profitable and not be liquid. In other words, be bankrupt or insolvent. We talked about the 3 categories of legal business structures, so proprietorship, partnership, and corporations, and advantages and disadvantages of each. We talked about the accounting equation, assets equal liabilities plus owner's equity, and its importance. Owner's equities can be thought of as net worth. We talked about that, and has many influences on there are many factors that influence the equity. There are 10 financial statement elements: revenues, expenses, gains, losses, assets, liabilities, equity, investments by owner, distributions by owner, and comprehensive income. And there are standard conventions in order of preparing financial statements: income statement, statement of owner's equity, balance sheet, statement of cash flows, in that order. Then we talked about financial ratios and some of their importance. Uh, they allow for comparisons between businesses and determining between periods and trends between periods. All right, that is it for chapter 2. If you have any questions, please let me know.